it's time for us to take on a tricky but fundamental topic in how the U.S. and arguably global markets function: the independence of the U.S. Federal Reserve.
On January 9th, the Trump administration threatened a lawsuit against the Federal Reserve, and the Justice Department launched a criminal investigation into Fed Chair Jay Powell related to the refurbishment costs of the Fed offices. This follows an ongoing legal battle about whether the administration has the authority to fire Fed Governor Lisa Cook for cause related to mortgage filings.
We believe these developments mark a clear departure from historic moments in which politicians have criticized Fed policy that doesn't align with their goals, from Truman to Nixon to Carter to H.W. Bush. In our view, current legal developments are overtures toward control rather than influence. This is also happening at the same time that President Trump is expected to announce his pick for Fed chair, the replacement for Chair Powell, whose term expires in May. So with all this considered, what is it that the Fed needs to be independent from in the first place?
Essentially, the Fed needs to be independent from politics. The Fed's mandate from Congress is to help the markets and the economy function normally. What this means in the practice is that the Fed has a dual mandate to ensure price stability and what they like to call maximum employment. In order to achieve these goals, the Fed has a lot of tools within its toolkit. They have the power to set interest rates, to oversee the banking system, and influence monetary reserves and liquidity. If politicians were in charge of these tools, it would mean that monetary policy would never become restrictive. Over the long run, this would create inflation. And as we saw over the course of the pandemic, inflation is really harmful to U.S. consumers.
We want to make three things very clear about this risk. First, we do not expect that the Fed will lose independence, especially in the near term. Second, a new Fed chair does not have the power to bring interest rates down on their own. And third, we're already seeing more debate and dissent within the Federal Reserve. This is normal based on shifting economic conditions.
Let's take these one at a time, starting with the Fed overall, or the Federal Open Market Committee, or FOMC, which set interest rates. We believe that the FOMC will stay largely independent.
The majority of this 12-member committee has implemented and continues to advocate for a traditional policy response to shifting macro conditions.
Second, any Fed chair, including the new chair that will replace Powell in May, cannot set interest rates on their own.
This is one of the most common misconceptions we hear amongst global investors. Any given Fed chair is influential, but cannot bring interest rates down by themselves. The only thing that the Fed chair is able to unilaterally control is how the Fed communicates with markets. This, of course, is influential in market pricing of uncertainty, but is not policy in and of itself.
Finally, debate amongst the Fed is normal.
This is the good news around the timing of this Fed independence discussion. Economic data is mixed. Economic growth is strong, but hiring is weak. Inflation has come down, but is still above target. This means that there is a wide range for legitimate debate around the policy path. It also means that more dovish policy from here does not necessarily need to spark market concerns around Fed independence.
Even though it's not our base case, it's worth closing with some of the indicators that we'll be looking at to see how the market would react if they view the Fed as functioning as less independent.
We see three key avenues for market impact. First would be the dollar, in which we'd expect to see greater hedging activity. Second are long-term market-determined interest rates, which we would expect to rise if markets decided to price in greater risk and uncertainty. Finally, a third avenue is inflation itself, seen first in rising inflation expectations.
But even with Fed independence now a highly relevant risk for markets, we have a very constructive outlook for 2026.
For all of our best ideas around this constructive market outlook, visit our website at www.newyorklifeinvestments.com/global-markets.